Okay, I think we will start now. We've got a number of participants here. Okay, I think we're good to go. Good morning, everyone. Great to have you here. This webinar series is brought to you by Ultimate Access. My name is Andrew De Alves, and I've got Sandy Hood all the way from the UK. I'm in Dubai talking to you, and Sandy is in the UK. Two different types of weather altogether. And Sandy, I'm sure you would like to come over to Dubai very soon.
Definitely, yes. We've had a little bit of rain this morning. It's
right.
Not raining at the moment, but the ground is still wet from the rain that we've been having.
Oh, okay. That's we don't mind some rain. I'm sure the guys from Dubai will agree with me. And today we've got a very exciting topic, and just to let the people who are doing strategic case study, I want to inform you that we will be talking about FIS and weighted average cost of capital as well. So do stay with us till the end, because we will tackle that topic right at the end. So I will give over to Sandy. Over to you, Sandy, to start off this series.
Good morning, everybody. Hopefully you can see a screen which has on it 1 hour sessions, helping you to improve your knowledge and understanding. My name is Sandy Hood. Obviously today's date is the 13th of May, and we're looking at the cost of finance, so it should be quite exciting. I hope some of you were with us last time when we looked at the capital investment appraisal. There is a little bit of a link between the two. It doesn't impede you if this is your first session that you're attending, but last time we looked at a hotel that was converting a library area into a gymnasium, and to do that we had to apply a particular post-tax money cost of capital. So yes, so last time we were looking at evaluating this particular investment, and we were using a 12% cost of capital, which raised the issue, where did that come from? And I said that we would have to wait and see, and today is what the waiting has been all about, and we will see how we would derive a cost of capital. It's a way of discounting our forecast cash flows. So for many projects where a company is engaging in the activities that it normally does, and where it is keeping the same level of gearing, then the weighted average cost of capital, the one that we're looking at today, WACC, is the method of discounting that is most applicable. No, I didn't say WACC, I said WACC. Oh, and that needs a different kind of superhero. And there you can see us, Andrew and myself. So it sounds the same, but it means weighted average cost of capital. We are averaging the different finance sources that we use to run the business. So we have to find what is the cost that we incur by having equity, and we have to find what the cost is that we incur having debt, and we have to bring the two together. So here's a little exercise that you can follow. If you look at the two, I've got 700,000 of equity where we're paying 8%. I've got 300,000 of debt where we're paying 5%. And we've made it very easy. There's no tax, and what we need to do is to find out what the weighted average cost is for this company as a whole. Now, do you want to have a little go at this?
Well, what about our participants? What do you think? And let's go to the next slide, Sandy. Yeah, I'm sure they have done this now.
So I've multiplied the two together, found out the two interests. Well, the first one is the cost that it incurs, the second one is the debt interest that we incur, and then we combine the two and then divide them by the total value of the capital employed. 71,000 divided by 1 million gives me a 7.1% weighted average cost of capital. And this should be used in order that we can then judge the viability of particular investment opportunities. Right. Okay. We've got two models that we can use. The one with the blue background is called the dividend valuation model. Now, for those of you who are attending this class as part of your exam preparation, this is quite a commonly examined topic, certainly within the CIMA F3 syllabus, on how to value the cost of equity. And what we do is we take the value of the dividends that we expect to pay next year, and we divide that by the current market value of the stock, and we add on the percentage growth rate of dividends that we expect to be taking place year on year on year. And this gives us the dividend valuation cost of equity. And that would typically be expressed as a percentage rate, rather like the 7.1% that we had in our previous slide. It isn't the only method, and another method is called the capital asset pricing model. And here we've got it with the rather sandy background. And this one says cost of equity is whatever the risk-free rate is, plus something we call the market risk premium, which is a difference between... If I was to mute my speaker, then you wouldn't hear me at all.
You're very clear, Sandy. So the issue is at the other end. So from my side, you're very clear. There's no problem. If anyone is having any issue with the sound, you need to log out and log back in. Sandy, just give me 1 minute. There might be people who will not be able to hear. I'm just going to put up a note here in our chat box. Okay, Sandy. Thank you. You can go on. Thank you.
Good. Right, I'm reading the second model, the capital asset pricing model, and here we're looking at the difference that the market generally pays over and above the risk-free rate, and then we would multiply it by something we call the beta. The beta is a company-specific recognition of risk. We will look more as we go into these in detail, but these are the two principal models that we use in order to work out the cost of equity. So taking the first one, the dividend valuation or the dividend growth model, we identify the dividends that we're going to be paying next year, and here we've got it using the symbols. Very often it appears with a small d, but here in our little caption it's showing it with a large D, 1 to indicate it's in a year's time. And we can we can identify this by looking at this year's dividend and then adding on some growth. The market share price, MSP, is at P0. In other words, it's the today price that the shares trade at, and G is simply the growth rate of the dividends.
Sandy, so you did mention that this is a favorite topic of the examiner, isn't it?
Yes, certainly within the OT exam, the CIMA F3 OT exam, I would be very surprised if an exam ever went through that did not touch this. This is a very, very popular financial strategy area within that exam.
How about the strategic case study?
Sometimes they look at it in terms of the application or the comprehension of what it is, rather than the mechanics of the calculation.
Right.
The thing about the case study exams is there's no requirement for any candidate to do any actual calculations at all in those exams.
Okay, thank you.
You're very welcome. And here is a little question for you to have a go at. A company has just paid an ordinary share dividend, so we're looking at the shares in the company being ex-dividend, and they've paid 32 cents. And in a year's time, they're expected to pay a dividend of 33.6 cents. And the current shares are trading at $4.20 or 420 cents, if you wanted to put it all into the same denomination. Can you work out what the cost of equity here is? We can use that formula that I was showing you a minute ago. Next year's dividend divided by the current share price plus the rate of growth.
Yeah, I think they would have calculated by now. I'm sure.
Well done. And hopefully you found that the rate of growth was 5%, and that as we were looking at the next year's dividend is of 33.6 divided by 420 as the current share price, that gives us a cost of equity of 13%. We now move on to the second model, the capital asset pricing model. And here, again, we've got a formula at the bottom as it would appear on an exam formula sheet. The risk-free rate, the rate that's paid on risk-free investments. Now, there aren't a lot of people who are able to issue debt that's completely risk-free, but we often think of governments in stable countries that are able to borrow money at a very low rate of interest, because there's very little question that the money will not be paid back eventually. So we often use the return that an investor would get from the purchase of a government bond. That's a good proxy for a risk-free rate. The other one is the market risk premium, which is the difference between the market rate of interest and the risk-free rate. And the equity beta is the specific risk factor that we would apply to the equity of a particular company. And you can see it fitting into a formula at the bottom, which corresponds to the written formula in the sandy box at the top. So we need to think about beta, and we need to think about beta not from the point of view of the business that's borrowing the money. We need to think about it from the point of view of the investors wanting to lend money and considering whether to lend money to this company or to lend it to another company, or even to buy the shares of this company.
Sandy, I've got a question for you. This is me thinking. And let's say when we're looking at that beta factor, so if I want to invest in a company in Nigeria or in the UK, right? So the betas would be quite different, isn't it?
Yes, yeah, you've certainly got a combination of risks that you would be considering, but the one of the differences between investing in a company, say in Nigeria, compared with one in the UK, is that there is a question mark over the business's ability to survive, and so that we would go through those pestle type measures of risk.
Yes.
And we would find that there would be a greater exposure to risk for a company operating in Nigeria, and so that would increase the beta of all the companies operating within that particular country.
Right.
Now they can do things to deal with that, but the risk is there to start with. Yes.
Okay. Thank you.
The other areas where we see risk is in terms of what's going on around the businesses and what's going on inside the businesses, so that you can have the nature of risk within particular types of business would be greater than it would be in other businesses. The ones that I tend to think of would be typically utility companies. So firms that are in the business of providing electricity and gas, they've got a pretty constant market of end consumers, and it's a fairly steady kind of business. Whereas other businesses that may be looking to investigate biotechnology in order to try and find cures to illnesses could have very, very good years, but may have several bad years, depending on the success of their investigations. So that kind of risk is inherent in that business, and that's fine. And what we've got on the slide that's showing at the moment is a diagram that can show you the total level of portfolio risk as somebody would increase the number of stocks that they would be holding. So as I go along the x-axis, from the origin towards the point of the arrow, you can see that the risk is falling. And what's happening there is that the wise investor is taking a combination of shares in order to reduce that unsystematic risk, to reduce the risk associated with those industries. Now in the UK, because we have some days when it's very rainy and we need to have umbrellas, and we have a few days when it's very hot and we need to buy suntan cream and swimming trunks, then what a shareholder might do is they would be covering themselves for either eventuality if they bought shares in an umbrella manufacturer and in a sun cream manufacturer. And that's what the portfolio of shares is about. It's about the diversifying what we call the unsystematic risk. And sticking with the UK, there will also be other risks. Certainly one of the risks that's current at the moment is associated with something called Brexit. The United Kingdom is in the process of preparing to separate itself from the European Union, and as such that poses a risk for every business in the UK. So that's a systematic risk. It's a risk that a share purchaser can't diversify away in quite the same way that they can diversify the risk associated perhaps with a suntan lotion company that discovers that it can't make any sales because there aren't any sunny days, or an umbrella company that can't make any money because it stopped raining. So those types of risks can be called unsystematic, and they can be diversified away by the investor, whereas the systemic or standard risk can't be. And so we have that combination between the two. We can't do a lot about it within the company, and when we're borrowing our money, it's the shareholders themselves that are able to diversify their risk away.
We've got a question from one of the participants asking, would that be the risk-free rate considering it's a government body?
Yes, I think that was the example I gave. We often use the return on government bonds as the risk-free rate. You're absolutely right, yes. So shareholders can't avoid the systematic risk, it's there. And on Sunday of last week, the stock market in France all went up, and that was because there was a general recognition that the election of Macron provided them with someone who was going to provide stability from the economic side of view, and perhaps a little bit of eye candy for some of the ladies as well.
That is so true. I agree with you.
Now, here I've listed some that I managed to find on the internet when I was preparing the class, and we've got a list here of some of the companies that have got very high betas and some of the companies that have got very low betas. And basically, a company with a high beta is more volatile, so it's going to have a greater responsiveness than the market as a whole. And I don't know how many of these you've heard of, but you might have heard of the Goodyear tyre. Goodyears are effectively a rubber tyre manufacturer, and they are a company where their volatility is 3.18 times that of the US market as a whole. So if there is something such as a change in government policy, this sort of systematic risk that you can't do anything about, then the likelihood is that they are going to have a greater reaction to it than, say, another company that doesn't. And on the other side of this slide, I've got these ones, some of which have got LSE, which means London Stock Exchange, next to them, and Unilever, the company that produces lots and lots of different products, cleaning products, some food products. Because they are in a stable environment, they have a beta which responds less. It's a 0.57 beta, meaning that if there is any volatility within the market, their volatility would be less than the market as a whole. So it goes to show that depending on your individual business, it shows the responsiveness that that business has to market-wide changes, and so this is quite important from our point of view, because we're able to use this within our formula. That final section in that sandy box is beta, and that would be the recognition of the individual company's equity beta in relation to how it responds to changes in the market. So, the cost of equity includes risk that the company faces from the business that it's in. Here we've got an example. Hex. Hex has got an equity beta of 1.2. In other words, it's 20% more volatile than the market as a whole. The risk-free rate is 4%, The average return on the stock market is 11%. So are you able, I will invite you to have a go at this and then put your answer in the chat box.
Yes, it'll be really good to have you calculating this cost of equity. Let's see how you guys go about calculating it. Let's give them a minute or so to calculate.
The values are all on the screen.
Yeah. Right, we've got 12.4%, yes. Shahad, Kumel. That's good.
This is looking good.
Yeah, Devna, thank you.
Well done. Well done, well done. So, there's a little reminder in case you were...
Very good, Akbar.
That's just what I was going to say as well. So 12.4%, yeah, we've got the risk premium, which is 7%, multiply that by 1.2 gives us 8.4, add on the 4, and we've got 12.4%. Yeah. So we said that there were two ways to find the cost of equity. Oh, well done, Ralph Catherine, 1973, yeah. And that's absolutely right. We had the cost of equity calculated using a dividend valuation model, and the one that we've just done was the cost of equity calculated using a capital asset pricing model. There are two ways. They will not necessarily give you the same answer. So I think that that's quite important. This isn't a sort of made-up schoolroom, classroom setup where all the numbers are going to work perfectly and that they will give you the same answer whatever you do. This is the issue is that we're dealing in the real world, and so the calculation of the cost of equity one way is based on what the company has done in terms of the dividends it's paid in the past and what it's planning to pay in the future, and the other one is based on interest rates in the marketplace itself. So don't expect the two to give you the same answer, but both of them are very useful in business, and you can use them to help assess what discount rate to apply to projects.
And the people who are sitting for the strategic case study, I think this is where you need to interpret both methods quite carefully, because they're going to give you two different answers, and the interpretation is very important.
Excellent, yeah, perfectly said, Andrew, yeah. The WACC calculated using the cost of equity and the cost of debt. We've looked at two ways to calculate the cost of the equity. We haven't looked at the cost of debt yet. Speed up a little bit. When the company borrows money, it pays the lender interest for the money in most circumstances, and we need to know what the lender receives to help us calculate the cost of debt to the company. So we're certainly going to be, I'm going to take you through this in the way that I would want you to do it. We initially start with the investor's point of view. We can do something slightly different after that. But the types of debt that we would be looking at could be bank loans, and they could be traded debt. And certainly in a lot of accounting exams we look at traded debt. Incidentally, in the FIS case study, I think it looks like it's probably more bank loans. But we're going to focus on traded debt within the context of this set of slides. And when we come to FIS, I will look at it slightly differently in the context of bank loans. So we typically think of debt as being fixed interest, so it's on a coupon, and sometimes it's difficult to understand what a coupon is. For old people such as myself, it isn't so much of a problem because we grew up when the vast majority of us never used computers. But this is a very ornate stock certificate issued by the City of New York, and on the bottom you can see a series of what looks like banknotes, and these are the coupons. And what would happen is that if you were a lender and you'd given $1,000 to the City of New York for them to use for the grounds and buildings of the College of the City of New York, then they would have given you this certificate as a receipt to show that you own this loan stock, and at the bottom they would have given you the various stamps, so that every year or every 6 months you would take a stamp along, and that stamp or coupon you would be able to cash in, and they would either give you the cash as your interest, or you would take it to the bank and the bank would deposit it into your bank account as your interest on the loan. So the coupon is the interest on the loan. And one of the things that's important from our point of view, and I think it helps to see this particular picture, is that the interest that's payable is the same. Let's say it's paid every year. So if it's a 7% or $1,000 bond, then every year the person holding it will receive $70. And it doesn't matter what the market interest rates are or anything else like that, they're going to be paid $70 because it's a fixed coupon. So here we've got a superhero who's going to try and help us with this particular question. Superhero Co. has $200 million loan notes shown on the statement of financial position. So if you see this kind of expression, this means that this is the book value. It doesn't mean it's the trading value. And each note has a nominal value of $100, but it's currently trading at $103.50, and they're going to be redeemed in 6 years at a 6% premium to the nominal value. So they're going to be redeemed at $106. Now, my question to you is, what technique should we use to find this percentage cost of debt? And we've got another superhero here. This one's got the letter A in the middle of her helmet. And I wonder if it's somebody that we know. But the answer I'd like you to put into the chat box is the technique that we should be using to find the percentage cost of debt in the scenario that we've got.
Let's get the people working now. Just give you guys a couple of minutes to work this out.
Just divided by 1. Good. The interest over the principal. Wow, somebody who's actually worked it out.
Great.
Okay. Lovely. I was at the what technique stage rather than the actual calculation. Good for you. So the clue, if any of you need the clue, is that we looked at this when we did the investment appraisal last month, and I don't like the sun that I just see, but anyway, and we were looking at the second workbook, which was the way that they found the post-money cost of capital at the hotel, and we called it the IRR, the internal rate of return. So in this particular case, I found two discount rates that I applied to the cash flows. So the cash flows are that somebody buying one of these bonds would pay $103.50 today, and then in each of the years 1 to 6 would receive $6 of interest. and then in year 6 would receive $106, because of course they're getting the 6% premium on top of the nominal value, and then discount it. And I think the more you do these, the more of a clue you get. That one of the clues is often that if your bond is trading at a higher amount than the nominal value, you can usually guess that that means that the bond is paying a higher rate than the market. So I would normally go in here, as I have done, and discount it at 5%. And what I found was that at 5%, I was actually getting a positive net present value. So I upped the discount rate to 7%, where I got a negative net present value, and then I brought the two together within an internal rate of return calculation and found that we were looking at 6.2%. So for those of you who were putting up answers which were basically the annual interest divided by the cost approach, what we've done here has been to incorporate the time value of money and to use discount factors in order to bring future cash flows to a present value as we stand today. So this particular management accounting technique has enabled us to calculate the cost of debt in respect of our investors, because I have to draw attention to that if somebody buying one of these loan notes and holding it for the next 6 years is earning an annual return of 6.2%. But that's the investor's point of view. We're looking at this really from the company that's issuing the debt's point of view. So the answer to the question, does this mean the cost of this debt to Superhero is 6.2%? The answer is no, except in very extreme circumstances. So virtually always the answer is no. And some of you may have studied a little bit of this before. So there is a little 3-letter word that is the explanation as to why it isn't 6.2.
Let us see, Sandy, if others will be able to, if the participants will be able to give us that, the 3-letter word. What do you guys think? Okay, Resdine, good on you. What about the others? I've got one answer. What about the others? Right, Mustafa, good. Saad, good. I think most of, no. Some of them are saying NPV. It's not NPV. That's not the 3-letter word.
That's not a word. That's not a word. NPV is an abbreviation. Has anybody come up with a word that begins with the letter T?
Yes, quite a number of them. So they have identified.
Well done. Yes, it's to do with the tax. You're very clever. So congratulations. If we assume that Superhero is a profitable company, and I think that's quite a reasonable assumption, then interest costs can be charged against taxable profits, leading to a lower profit and a lower tax. So by paying interest at 6.2% on the loans, they will be paying less in tax. So the net effect is that they're going to have a cost of debt of 4.65%. And I can see that our little Superhero is jumping for joy.
Exactly, very happy because it's due to tax. We've got a lesser amount, isn't it? The cost is actually much less.
Exactly. it makes borrowing more attractive. So the cost of debt is 4.65%. Superhero has 200 million of 6% loan notes, shown as debt on the statement of financial position, and each note has a nominal value of 100, trading at 103.50. It makes the question a little bit easier, the fact that I've said that this is X interest. So the trading at 103.50 is after they've paid their interest, and they're going to be redeemed. So we know the cost of equity, we know how to find the cost of debt, we know how to combine the two, so we're going to put something into practice. Here we've got a company called Fence. They've got 100 million ordinary shares. No, they haven't. They've got 10 million ordinary shares, and they trade on the stock market at $7.50. They've got 7% bonds with a nominal value of 14 million. The bond interest, they are X interest. The interest has just been paid. They're trading at 107.14. We've got a risk-free rate of 4%. We've got an average stock market return of 11%, and we pay corporation tax of 20%. We've got all the facts that we need to work out the weighted average cost of capital. We have to use the CAPM approach because we're not given any information about dividends. So we find the cost of equity, then we find the cost of debt, we find the market value of equity, we find the market value of debt, and then we combine them. So cost of equity, we've got a nice little layout here for putting it all in and finding the answers. So cost of equity, 4% for the risk-free rate, plus 11 minus 4, 7% for the market risk premium, but that's multiplied by 0.9 because Fence is considered to be less risky than the market as a whole. That gives an answer of 6.3, add on the 4, and you've got 10.3% cost of equity. We've got the cost of the debt. We know that these are trading at 107.14 X interest, so that's how much somebody would pay for them. And on the basis that they're paying 7%, but they're trading at a higher amount, I've discounted them at 6%, and that gave me a negative amount. So I then went lower and found that the net present value of 5% was positive. Putting it into the internal rate of return formula, 5% plus 4.46 divided by the difference between the two, multiplied by the 1% difference between the two discount rates, gives me 5.7%. So the cost of debt at Fence is 5.7%. Third value, let's find the market value of the equity. We know how many shares they've got. We know how much each share is trading for, so we can work out the market capitalization. 10 million, lots of $7.50, 75 million. And we can do something similar with the debt. Each bond has a nominal value of $100. It's got a market value of 107.14, and the total value, according to the statement of financial position, is 14 million. So 14 million times 107 divided by 100 gives me market value 15 million. We now have all the components that we need to go into the calculation of the weighted average cost of capital. So about a third of the way down the page we've got the formula. KEG, the cost of equity, times the proportion of equity within the total capital of the company. plus the cost of debt. And now we've built in that little modification that incorporates the tax benefit. So the cost of debt 1 minus T times the proportion of debt out of the total capital employed in the business. We know it's 10.3% cost of equity. We know it's 75 million for the value of equity. We know it's 15 million for the value of debt. And the cost of debt, 5.7%, but 1 minus 20%. So we begin to fit this into our formula. 10.3%, 75 over 90 effectively. And we get 9.3%. That's our weighted average cost of capital. 9.4 is fine. Well done. What would we do with it? Batman, you're not watching the words, you're just listening, and it sounds so similar. I did say WACC, not WACC. Right, so we would use it as a discount rate when we carry out an investment of appraisal of projects. But as we said at the beginning, these projects would have to be part of our normal activities, and they would have to be with the same level of gearing. WACC can help us find the value of a business. We can get the annual earnings, and divided that by the WACC is one way of valuing a company. So in our case, we know that the annual earnings was 7. We don't know. I'm telling us that the annual earnings was 7.44 million. We know that the WACC was, well, I said 9.3%. So that will put a value on the company of 80 million. So here is our formula again, just showing the calculation. I have had a question, but I didn't quite understand it. I think what I'll do is I'll try and address the question that somebody was asking, that we haven't really presented a project. So all that we've done has been to come up with how we would discount a project. In order to make a judgment as to whether a project would go ahead or not, we would have to see whether that project was generating a positive net present value using our weighted average cost. Okay. Now I know that in the previous class there was one gentleman who had asked about other things, and there were a couple of academics in the early 1960s who found that there was another way of working out the WACC, and what we can do is we can try and separate out the cost of equity of a business that doesn't have any debt, what we call the ungeared cost of equity. And in the little formula in front of you it says KEU, that's the ungeared cost of equity of this particular firm, and we're going to multiply that by 1 minus effectively the tax cost divided by the total capital employed. So what that does is it brings down the total weighted average cost of capital. So we would expect an ungeared company to have a higher weighted average cost of capital than an ungeared company. The ungeared company to have a higher one than the one that's got gearing. And we'll look at this using a couple of diagrams in a minute. But we had fence was geared, but we're going to reduce the gearing to 0, and so the cost of equity will fall because they're not carrying any risk. So you've got these two diagrams, they're both telling us the same bit of information. But as you increase the level of gearing, then you increase the cost of equity. And that's the top row. So one of them shows it as a slight curve and the other one shows it as a straight line. But they're both demonstrating that the more gearing you've got, the more you would have to pay the shareholders as a return for their investment. So because the gearing adds financial risk, there's no financial risk at zero gearing. So what we're going to do is we're going to look and see what's going to happen. Got the same information in the standard that you saw before. We bring in a formula that would be provided within an accountancy exam, which shows that the ungeared beta of a company is equal to the geared beta times the proportion of equity over capital employed, plus if there is some debt and the debt carries some risk, then that proportion as well. But very, very often the beta for debt, the beta D as shown on your diagram, would be given as 0, which would begin to make the whole formula a lot easier. So looking at the blue table in the middle, you can see that we've got the information that we've used before. The cost of equity of a geared, this fence company geared, is 10.3%. And the value of equity, I've just paused. That wasn't 10.3%. Yes, it was. Sorry. Yes, yeah, absolutely right. So the 75 million for the value of equity, 15 million for the value of debt, and then we've got that the geared equity beta was 0.9. As soon as we know that the beta for debt is 0, then anything times 0 is 0. So we only need the first half of the formula, and we work that through to give us an ungeared beta of 0.78. That's quite logical. The shareholders consider that the shares are more risky when the company has got debt, so they have a geared beta of 0.9. They consider the firm is less risky when it's got no debt, so it's got a beta of 0.78. So we apply the 0.78 using the CAPM formula, which gives us a ungeared cost of equity of 9.5%. We can then put that into this other formula where we recognise that the overall WACC, the weighted average cost of capital, will fall as we're able to take advantage of the tax deductibility of interest. And here we've got 9.5% times 1 minus the tax saving divided by the cost of equity plus the cost of debt, divided by the value of equity plus the value of debt, and that gives us an overall weighted average cost of capital of 9.2%. So instead of getting the components of the weighted average cost of capital and working each of them out and adding them up, what we've done is we've just found what would the cost of capital be if we were only ungeared, and then we've multiplied them by a multiplier in this case, which brings it down.
Sandy, if you can go to the previous slide, please, just to summarize. The next,
So,
no, the next one, please. The previous one to this. Yeah. So what we are saying is, as soon as so when we have debt as part of our whole funding structure, the shareholders obviously feel, well, there is risk here, so then they demand more return for their investment, and also the risk part of it is reflected in the beta, isn't it? That's what you said previously. And then the second part is, as soon as we take out the debt component and we're only looking at the equity, one thing to consider is the beta factor, because we need to adjust that beta factor to only represent the equity and not the debt, because the debt is not there anymore. So the shareholders do not feel, well, there's a huge risk here because we've got debt to consider. So therefore the beta comes down, and as a result our this calculation of 9.5 is lesser than the 10. I think it was 10.3, isn't it, previously?
Absolutely.
Yes.
And I'll show that diagrammatically here.
Yes.
That if you are at this same point X, where there's an element of gearing,
yes,
then that could be where we are having to pay our investors 10.3%. But if we move to the left,
right,
to the point where there's zero gearing,
yes,
then the shareholders don't need to be compensated quite so well, because their level of risk is less. Yeah. So that so looking at that line, the KE line, as you go towards the left, then you see the cost of equity falls as the gearing falls.
Right.
The two go side by side.
Yes, correct. I hope it's very clear to everyone. Thank you.
No, super. So I think we must be quite close to the in accounting exams. It will obviously depend on what information you've been given. In real life, the existence of several types of debt. So it's quite nice for us. We might have 3 or 4 sections, perhaps at the most, in an exam. In the ones that we've looked at up to now, we only had 2. But in real life, you may have a mixture. So it tends to be more appropriate if you're preparing the WACC calculation for your firm to use the more traditional approach with the particular cost of equity times the relative value of the equity to the total capital employed, and then each of the different debts, and then combining that. So we've learned to calculate WACC. We've learned in the previous class to calculate net present value, and we can now take a set of data and produce a WACC, and then go on from there to find the net present value. So we can continue with this character looking on at us. So I hope that was handy. I know that some of you want to stay on now and do something with Fizz.
Yep. Sandy, so
any questions based on the main part of today's class?
Are there any questions? So till Sandy prepares the other set of slides for Fizz, just want to share some information from us, particularly for people who are in the GCC and in Australia. CIMA has come up with some new programs, and I'd like to share that information with you. One second. So I would like to share my screen with you and show you what CIMA has come up with. 1 second. So I will take the presentation from you, Sandy, for a little while. Just 2 minutes. So we've got quite a number of participants, which is great. So this is for people who are doing CIMA or any other accounting qualifications based in either GCC or in Australia. So CIMA has come up with some new programs called the Corporate Professional Pathway, where if you have one year or more qualification, 1 year or more experience, and some of the qualifications, I know some of you have got degrees as well as MBAs, you will directly go into the operational case study level, and depending on your qualifications and experience, you may get exemptions from this one and move to the next level as well. And if you're at a very, very senior level, at the CFO levels, and you are looking to enhance your career with a professional qualification, you will directly go into the strategic case study. So really, it's a fantastic way of entering this professional qualification, where you will not need to do these OTQ exams. However, as a tuition provider, we will provide you guidance here, but you need to sit only for 3 exams if you come in at the operational case study level. So this is the kind of time frame that we're talking about. You will get on completion a diploma in management accounting, then the advanced diploma and the prestigious CIMA and CGMA. And this can be done maximum within 1.5 years. You can complete it. And the delivery schedule is this, right? So it's quite good. Within 5 months you can complete the sessions. And yes, so that's what I like to share with you. You will get this information as well. If you want to share it with others, friends and family, that'll be great, because it's a great opportunity for anyone to get the CIMA CGMA designation. Over to you, Sandy. Yes.
Oh, good. Very good likeness. Right, Fizz and WACC. So, Andrew said, can I have a little bit of a look at Fizz in terms of WACC? It involves a lot of guessing, I'm afraid. But here's an attempt so that we can have a think about it. I think that the numerical aspects will probably be less valuable than the getting to grips with Fizz as a company benefit that I think that this should have. So we know that they're described as a large company. We know that they've got a quote on the Northern Stock Exchange. We know that they've been around for 55 years. We don't know how many shares they've got in issue. We know that there's a book value, and that book value hasn't changed. So we've got some other things. As we go through the pre-scene, there is a chart of the share prices of Fizz and Quench, and maybe I read that to be they were worth about $8. On second thoughts, looking at it now, it looks like they're probably worth about $9. But I'm not unduly worried about that. That you can certainly see on page 20 that there is a share price for Fizz, and you can also see how it has been moving over the previous year. the kind of share price graph that you could access from sort of any investor site. The one that was probably one of the more popular ones in the UK is called Morningstar, and these sort of plot the share prices, and they're used by a type of investor called a chartist. But also within the pre-seed, we're given a set of ratios that hasn't actually been used in previous case studies, which, of course, from my point of view, sort of makes a bright light shine. It makes me think that we've got some intention of using them. So we've got the ratio of the share price to the sales ratio, the ratio of the sales price to the sales value, the ratio of the share price to earnings, and the ratio of the share price to book value. And so I sort of applied them here with a market share price over sales of 1.77, FIS with total revenue of 336.2 million would be expected perhaps to have a market capitalization of just under 600 million. On the other hand, if they had they've got a profit after tax of 66 million, then with a PE ratio of 26.2, we'd be looking at a market capitalization of around 1,700 million. So quite different. And the third one, looking at the market share price to net book value of 6.05, that would, given that FIS has got net assets of 272.8 million, that would suggest a market capitalization of 1,650,000. So, I think I said that wrong, 1,650 million. So we've got these things that we can consider fairly accurately. We have to make some guesses. So I've made a guess that there's 200 million shares in issue, each with a market share price of $8. Well, fair enough. I mean, if I'd have read it off correctly at $9, I would have probably had a slightly smaller number. But it's still reasonable, a reasonable enough assumption. So that would mean that we could work out some ratios for FIS, and we would start off with a market share price to sales of 4.76, which is well above the median value of 1.77. But the PE ratio of 24.24 compares reasonably similarly. So we look along the right lines, and the market share price to net book value, which is a bit below the median, again, probably recognizing that the market itself probably doesn't rate them fantastically highly. They have had a fall in profits, and you get this inefficiency, don't you? We talk about the efficient market hypothesis, but there is some emotional aspects that go on in terms of the determination of share prices, and it may be that we're not quite the darling of the market that some of the other companies are, so we are a little bit below the market median in that respect.
Sandy, that is very true compared to what's stated in the case study as well, isn't it? If you can go back to the previous slide, please. Thank you. So the first ratio that you stated, 4.76 compared to 1.77, how could you interpret that, Sandy? What does that ratio actually give us?
I suppose if we were to have a median value for our share price to sales revenue ratio, we would have much higher sales, which would probably indicate that we are selling at a premium. It might even indicate that we are a differentiator rather than a cost leader in that respect. I mean, obviously there's no profits within that calculation.
Correct.
And there's no costs within that calculation. But it gives an indication that our sales volume, if we were a premium product, would tend to be low, which would then push up a share price to sales turnover figure. If, on the other hand, we were a mass producer of soft drinks, then we would have a much higher sales revenue, and that would bring down the ratio closer to the median. Is that making any sense?
Yes, it does make sense, and it does reflect Fizz's, the characteristics of Fizz, I think. And you have, I think for the students, because I posed one of the mock questions on something like this, and it was very interesting. Students did find it very difficult to answer that, and did not bring in these ratios into the discussion. So obviously, guys people who are doing the strategic case study, I think you can get some valuable lessons from what Sandy just mentioned. If you are bringing in assumptions, please do state it in your exam paper as well, because the examiner, fortunately or unfortunately, cannot read your mind at this point. So always state your assumptions. There's no problem there, and you can see how well you can interpret bringing in the ratios that the examiner has already stated in your pre-scene. Over to you, Sandy. Thank you.
Well said, Andrew. Absolutely well said. And yeah, and fair enough. I said to you that I think that if I was to do this a second time, I'd probably put the market share price at about 9. But I honestly don't think the examiner would change the number of marks around it.
Yeah, that's right.
It is, as Andrew quite rightly said, that you make your assumption and you state it clearly, and then you work through it. I'm always unwilling to recommend opening up the pre-scene during the exam. I think that the time pressure is so great that you need to go in with this knowledge in your head already. And I wouldn't worry very much about the precision. I mean, what I think is important is that you've got the general picture that the market capitalisation within the soft drinks industry is running at about 1.8 times the value of the sales. That the market capitalisation is running at about 26 times the value of earnings, and that the market capitalisation is running at about 6 times the net book value of the assets in the company. And if you've got that, then you don't need any more than that when you're doing your sum. So don't spend sort of 30 seconds pressing a button and then another 30 seconds scrolling through the pre-scene to find 1.77 when you could have guessed at 1.8. That really isn't a good use of the exam. So here, when we looked at our WACC earlier on, I said about the 2 methods of finding the cost of equity. Well, here we've got, I'm going to work us through and see if we can do it for Fizz. And you may have already identified this, but there appears to have been a dividend paid of 30.8 million. It's highly likely that that's the reason why the balance brought forward on the retained earnings hasn't gone up by exactly the same amount as the profit after tax. So if we're going to work on that basis, then we can try and work out the cost of equity on a dividend valuation basis? Well, we don't know if they're growing. We don't know if the dividends have been going up in the past. We don't know if they've even been going down. I'm going to have a guess that they've stayed the same. Now, you've always got to base your answers on, first and foremost, the unseen, and then your recollections from the preceding. So you certainly can't base them on something that I'm saying now. But I think I'm making quite a logical guess based on the fact that the value of the profit after tax has fallen. So it makes sense to say, instead of falling profit after tax, they probably wanted to try and appease the shareholders, so they've held on to the same dividend that they've given them in previous years. So I've made the assumption of no growth. You can make the same assumption provided you haven't been given information to the contrary. And I tend to work out my cost of equity using the big numbers because it saves a lot of extra sums. But for your benefit, I've done a table here which shows both the dividend and the dividend per share. So in this case, I've got the total dividend that they paid last year, and I'm assuming it's going to be the same next year, of 30.8 million. I've assumed no growth, and I've used the market capitalisation of 1,600 million. So on that basis, I've got a cost of equity of 1.93%, which is fine. The maths has worked that out. The accountant in me is thinking, that's very low. Would they suffer that? But that's how the formula would lead us to believe. And I think that this kind of an exam is a real opportunity to demonstrate that second aspect, that accountant in you understanding of the figures says, this doesn't look realistic. I think that where it catches somebody else is let's just push it through the numbers of the formula and let's see what the numbers of the formula tell us. Because you then get that difference and the examiner says, so I can identify somebody who is suitable to pass this qualification as opposed to somebody who is merely trying to do lots of mechanical sums without really understanding what they're showing. So here we have it. It doesn't agree with the theory, so I've got to go back and try again. And what I'm going to do now is to look at it in terms of the earnings. So my D1 value has changed. Instead of using the dividend, I'm now using the earnings, the profit after tax. Now that gives me a 4.13% cost of equity, which again looks low. We've got a number of people who are part of the family that set up the business involved, which could mean that they are a bit more patient than most. But certainly if you're involved with businesses like this, then you can well imagine that you'd have shareholders standing up and shouting at annual general meetings and things like that if this was the kind of return that they were getting. So this is our guess. We've made a whole load of assumptions in order to get there. We do know the debt. We do know that the borrowings are 21.3 million. And we know that this is a cash cost of 1.1 million. That suggests an interest rate of 5.16. But again, our examiner likes to see that you've had a broad look at the company as a whole and that you haven't been sort of narrow-minded and funneled into this. So I looked a little bit further. I could see that the intangible assets has gone up. And there's a fair chance that we've capitalised some interest. So although the statement of profit or loss is showing a 1.1 million cash cost for interest. It could be that the company's incurred a higher cost of interest, some of which has been capitalised into the intangible assets. So I suppose, and partly because I don't like fiddling about with 5.16%, I'm going to assume that we've got a 6% bank loan. And of course, bank loans don't have a market value. So they would tend to go into the weighted average cost of capital calculation at book value. And I looked at the tax paid. We've got 4 lots of tax paid within the pre-scene. And we know that we pay tax on taxable profits, not on accounting profits. And we're given the accounting profits, but we're not given the taxable profits. So I had to make a bit of a guess, and I suppose I had to make a bit of a rounding to make it easy for me to do sums, and I've gone with 10%. So, fitting these numbers in, I've got a 4.13% cost of equity. I've got a value of equity of 1,600 million. I've got a value of equity plus debt of 1,621 million. Incredibly low gearing. I've put the cost of debt at 6%. I was just listening if you were shouting at the screen thing, you can't have debt higher than equity. But anyway, the debt is costing us more than the equity. And then I've deducted 10% for the tax. And I've multiplied that by 21 million for the debt divided by the 1621, which is the total capital employed, which has given me an overall weighted average cost of capital of 4.15. Well, we've done a WACC. It's based on some guesses. Were the sums useful? Probably not. It isn't realistic to look at paying lenders at a higher rate than shareholders. And 4.15% is quite low. And does it really recognise risk and so on if we're going to use it to discount future projects? So, as a number crunching exercise, not brilliant, but was the process useful? Yes, I think most definitely. I think that it opens your mind up to the kind of information that could go in an unseen exam. I think we can recognise the median values and the usefulness they have in making comparisons with FIDs. And it forced us to think in detail about the financial structure of FIDs. And it's interesting for someone such as me who reads the examiner's reports every 3 months. I know that one of the criticisms that the examiners come up with again and again is a lack of understanding of the financials of the business. You will probably be quite shocked to hear it, but there are candidates who will be entering this exam in a week's time, or just over a week's time, and what they think that they have done is to have gone through and produced a whole load of ratios, and they think that they understand what FIS is all about and that they can do these financial calculations. It's not that. It's you've got to get underneath the sort of numerical aspects. You've got to read what the financials are telling you about things. And I think that what we've done here has been just that. The question that Andrew was asking me in relation to the 3 ratios that we calculated in terms of how FIS differed from the median was doing just that. It was getting under the skin of FIS. It was making us think about why have we got a ratio that's so much greater? Why is it that we're not in line with the median? What is it that makes us different within this marketplace from the average for the industry there? And I think that that's really where you get the edge over those other candidates who have tried to do a rather more prescriptive, maybe rather rudely, a slightly lazier approach. So I think once you've got under the skin of it, then you start to come up with answers that make far more sense and start to accumulate the marks more quickly.
Thank you, Sandy.
So how could it be tested? Sorry?
Thank you. That's quite useful, because I think the process is the most important, the steps that you undertook, as well as getting us to think about, really forcing us to think of certain things. At this point, guys, it will be assumptions. However, if you are aware of those, examiner has given you 3 market ratios, right? These are hints, clues for us to understand what are these, what does it say, and how can it apply to FIS and the industry per se. Yes, Sandy, thank you.
No, absolutely. And so they could be asking you to explain the components. And please, whenever you write a paragraph within these exams, you've got to be writing about FIS all the way. If you start writing down paragraphs that could have come out of textbooks that just describe WACC or cost of equity in a general sense, then you won't be earning marks. You need to be keeping your explanation of the components very relevant to FIS. And if they start giving you questions that could be that FIS are considering whether or not to finance growth using an increase in the number of shares, therefore raising the equity element, or they're considering financing it through issuing loan notes, or even going to the bank and getting a greater bank loan, then you've got an opportunity to then explain it in the context of FIS rather than in the context of a textbook. You've also got the opportunity to be able to go into the details on the tax shield. I think because the figures I was having to use were all over the place in terms of what the tax percentages were, I think that they are likely to tell you that within the unseen information. And then you can say how that has an effect. And of course, as the tax percentage goes up, then the tax shield goes up as well, because you're effectively saving more of your interest cost. And you could also be asked to consider a project where the risk is different. And you might have a scenario where you've had 2 directors contact you, one of whom has shown that their expertise is not in the financial area, and they don't quite understand why you would want to use a different discount rate from the WACC that the company uses as a whole. And then you've got an opportunity to be able to explain the fact that you're moving into an area where the business risk is different from the business risk of our own. And as we did when we did this in the previous class, looking at the Modigliani-Miller approach to WACC, that you would then have to look at the re-gearing the beta, so that you're able to then come up with a useful discount rate that takes account of the different level of risk in the different area that you may well be expanding into. Right, now is your opportunity to ask questions. What do you think? Has it helped you to gain a further understanding of things? Do you feel those carbon dioxide bubbles whizzing through your veins?
I think there are a number of people who are here. Yeah.
I've managed to end the slideshow.
Yes, so people are saying that it is quite useful, Sandy. I think this is an area which is which is confusing, and people will get bogged down in trying to calculate the mathematics side of it, but interpretation becomes really important. That's important. Yes, Patricia says, Sandy, thank you very much. It was very useful. I have posed a question, something, like I said, something quite similar, but people did not pick up the hints that was given by the examiner in the pre-scene. So it's important to bring in things from the pre-scene to apply to your answer. Yes, there are lots of people who are saying it is quite useful, even though we had to make assumptions. Another major point here that you need to remember, guys, is to ensure that you state your assumptions in the paper that you're writing, so that an examiner can see this is your thought process and give you marks for that. With that, we conclude today's session. Thanks everyone for joining, and Sandy, you certainly have been my superhero. It's a great session today, a lot of insight, a difficult area. When I was studying, I just couldn't understand this very well. A lot of formulas, the interpretation, but you made it really easy for the students, and also bringing in a case study where we do not have much information about, and then interpreting the whole thing. Thank you so much, Sandy, and all of us enjoyed it very much.
Well, thank you, Andrew. You're a superhero.
Yep. Thank you very much, everyone. So we will see you again next month. I'll send you out an invite for that. Thank you. Yes. Thank you, Sandy. Speak to you soon.
Thank you, Andrew. Lovely. Speak to you soon.